So the Fed is now cutting interest rates, and normal people should care about these types of things, and they probably do. I mean, it's like any financial topic. You think you know something about it, maybe you know a lot about it, maybe you know a little bit about it, but in many cases you don't know what to do with the information in your own lives. So we think, Doug and I, that this idea of financial literacy is something we could all improve on in this country. Young people, old people, middle-aged people, you name it. And we think one of the keys to doing that is you just can't be afraid to ask dumb questions. So no dumb questions is now officially on the air, so to speak. So Doug Flynn has been in the financial world as a financial pro now for years and years, has his own firm. It's called Flynn Zito Capital Management in New York. And he's basically been answering dumb questions from his clients and people like me on TV and radio for years. And me, I'm Connell McShane. I have been covering the financial markets, asking those dumb questions for years and years. Now I have a general news show on News Nation that Doug contributes to. He's on a few times a week. It's on from 3 to 5 p.m. On News Nation on cable news. So this idea, the Fed cuts rates. So like the biggest picture way I think to look at it is you hear that, you say, what does that mean for me? What does it mean?
That means a couple of things. You have to think about which hat you're wearing. Are you a consumer or are you an investor? And so on the consumer front, you're borrowing money oftentimes, and you're also then saving, and that's where the investor hat comes in. So on the consumer side, when you're borrowing, you are possibly going to be paying a little bit less on interest rates in terms of credit cards. That's a good thing. Also, auto loans, those tend to come down a little bit quicker. And mortgages are not tied to that. We can speak about that. But some of those consumer loans will definitely be impacted with the lowering of interest rates. Also, home equity loans are also tied to the prime rate, which is one of the key indicators that the banks will follow when the Fed lowers. You'll see the prime rate get lowered, and then those rates that are tied to that, like home equity loans, will come down. So you're paying less, and that means things get a little bit more affordable. It's to help the economy.
It makes or it brings up a good point as you hear they cut rates. They're talking right about their overnight bank lending rate that the Federal Reserve has. But which, and you mentioned a few other interest rates, which rates are affected, which are not when someone hears the Fed cut rates?
Yes. So the Fed is focusing on their overnight lending rate, their short-term rate that they impact. That's really all they impact. They don't have an impact on long-term bonds or long-term bond rates or what corporations pay. So that immediate sort of short-term rate will come down from what it was above a 5% rate. And then it'll start going down into the 4% range in the high fours, and it'll keep lowering because the Fed has indicated they're going to continue to lower to help the economy going. And so that has an impact on all the rates that are tied to that. The bank prime rate will then get lowered. But when you talk about mortgages in particular, mortgages are typically follow the 10-year Treasury, and the Fed lowering rates doesn't impact that. The 10-year Treasury rate already went down a lot in the anticipation of the Fed lowering rates. And so the mortgages, if actually the 10-year and the mortgage rate didn't move in these past couple of days because it isn't tied to the rate that the Fed controls. So
the other thing I thought that you mentioned that's interesting is like we kind of associate Fed rate cuts with good news, like, oh, money's cheaper, I can borrow more money. But as you said, some people don't use interest rates because they're savers and benefit from higher interest rates.
Right.
So that gets back to my, first point is like, you watch the news, you kind of know what it means, but it's like, what do I personally do with it? The borrower versus the saver, because, savers for years they weren't getting any money. And now recent years they were. Now that might change, right?
Yeah. You got your, so while you're paying less on the borrowing side, on the saving side, you're also getting less. And so there were many money market mutual funds that were paying over 5%. You can get 5% CDs. And so though the banks will now lower their rate because they're getting less, so they're going to give less. And so you're going to see those CD rates come down. You're going to see those money market rates come down immediately. And so what will happen is if you're a saver, while it's been good and maybe didn't feel the need to do a lot or anything differently with your savings in the bank or in the money markets, you're going to see those rates come down in lockstep with rates coming down, with the Fed lowering rates. So those yields that you see will come down if you're in the 100% liquid type money market mutual fund or CD or a savings account. So That's the opportunity now to say, well, hey, if I know that those rates are going to come down, if I know CD rates are going to be lower in 3 months or in 6 months, now is the opportunity to lock in something for whatever time you can. If you have X amount of dollars and you can afford to tie a little bit of it up, then it does make sense to do that now if you haven't already done it. You may have missed the absolute peak, but
Right.
it's still going to be better than it's going to be in 3 or 6 months or even
Is
a
that what
year
you're
from now.
dealing with now with people coming into the office, especially older people, maybe in some cases where they're living off on a fixed income and want to add to their
Sure.
fixed income with some interest. They want to get paid interest. So what when you say you put it into something or lock it in, what types
Right.
of things are you talking to people about?
Yes. So CDs are the easy one if you want to stay FDIC insured and keep it in the bank. But you have what we call reinvestment risk. If you choose a 6 month CD, it's very likely when that renews, it's going to renew at the lower rate. And quite honestly, that's what banks rely on. You can almost tell where they think rates are going to be the lowest because they do what's called teaser rate CDs to
Mhm.
entice you with a 7 month CD or a 13 month CD because they know that 80% of the people are lazy or busy and are just going to auto renew if you don't tell them at the lower rate at that point in the future. So, how you get around that is you have to be more active on it when the renewals are happening, or you look to something like a short-term bond fund, which does have some volatility, lower end volatility, but still volatility nonetheless. It keeps it more liquid, but you can lock in some of those 5% yields that are still there in the short-term bonds. And the beauty of bonds
Right.
is that as rates come down, you actually get the prices of those bonds rising, which not a lot of people understand. They may know when rates go down, bond prices go up. We could talk about why, but that is an opportunity to pick up some extra return on top of the locking in of the yield over the next year or two, especially while the Fed lowers.
Well, it is interesting because I think, especially for younger people who want to be aggressive in their, the 401ks or their investments, they hear that a low interest rate environment, if we go into one again, is generally better for stocks. But then you're saying in this particular case right now, you're looking maybe more at bonds. And maybe to your point, you could explain that a little bit.
Sure. So if historically, especially over the last 7 times when the Fed has stopped raising rates and then cut, you
Right.
can see what's happened as a student of history, 1, 3, and 5 years after that period. And there have been multiple periods since 40 years ago where this has happened. So history may not repeat, but it rhymes. So we know similar
Yeah.
things are going to happen. And so if you look at it, you're going to see that as those rates come down, the stock market does okay. It does its normal overall return, but bonds do way above their normal return. So you could argue that the returns you're going to get on the fixed income side are going to be pretty similar to what you're going to get in the stock market over the next year or two, with only 1/4 of the risk or volatility. So
Hmm.
if you have a goal that's in the next year or two, that's the opportunity to say, hey, the market's at all-time highs. Maybe I take some profits, book those because volatility is out there. And then I can still do pretty well on the short-term bond side as the Fed begins to lower. Now, fast forward to 2 years from now, if the Fed's done lowering rates, you're not going to get the same return in bonds that you will in stocks over the long haul. So when you have a goal of 5 or 10 or 20 years, stocks are the way to go if you have that volatility and time frame. But in the next year or two, it's kind of one of those opportunities we don't often get here as investors, but
Right.
here is one.
It's interesting for younger people who haven't been through all of this, maybe just getting out of school or in their 20s and they're trying to get a little bit of money and are thinking about investing it now. What types of things do you think they need to look out for? What types of mistakes do you think they need to
Yeah.
avoid? Because they might say, well, interest rates are coming down. Maybe I should borrow more money because it's not as expensive to borrow money. I want to get a car, or maybe I'm thinking about a house or an apartment, or
Mhm.
and I've heard people talk about good debt versus bad debt. What would you
Right.
tell a younger person? Because we've talked a lot about kind of older people with a shorter term horizon so
Sure.
far.
Yeah, I think you have to know what your goals are first off. If you have a goal like I need a new car, you may need one. The rates will be lower, and they'll probably be even lower in the next 6 months or a year. So you're going to get more affordability. So this is what happens sometimes is when people know that rates are going to be lower, they might delay their purchases a little bit. But
Okay.
what will happen is, as you know, competition happens, they'll start throwing out some really low interest rates because the banks are going to know that they don't want people to wait. So they'll entice you now with a lower rate now to get you going because they know that they're going to be able to offer that without an issue because those rates are going to be lower in 6 or 12 months. So they'll start to move things ahead and get people going. So it comes down to I wouldn't just borrow for the sake of borrowing, but you're also going to see eventually those mortgage rates dip into the fives, and then realistically, a year from now, they could be in the fours. That's when everything really gets moving. But I would say this. People don't tend to mind the time frames on the investment front. They want to, investing in stocks and AI is exciting, and you
Right.
could certainly do well there. But I always think if you have a goal that's 1 to 2 years from now, or even 3, is it worth all that risk and volatility for a goal that short term when you have this great opportunity on the fixed income side to do really well with much less volatility?
Interesting. So even for younger people, their goal might be to move out, or their goal might be to get their young family might be to get a house as opposed to rent, that kind of thing. So the horizon could be short even for younger people, the time horizon.
You have to let the time frame rule what you're doing with the money. If you need all your money in that time frame, look, stocks are great 5, 10, 15, 20 years, no question. You have the volatility, like retirement, 401k, great. But if you have a I want to move out goal or something in 3 years, you want to start at the all-time highs, reeling that in and picking up some of these other things. Because the last thing you want is the day, week, or month before you make this probably biggest commitment of your life in buying a house.
Right.
If the stock market has a major correction, you're going to have a lot less money the day you go to close, and you're going to be scrambling. So you avoid that by minding the time frames. You want to do different things in the 3+ time frame, the 5+ time frame, the 1 to 3 year time frame, and certainly when you're within a year. What are we doing in the stock market with less than a year to go? You really want to reel that in, and people don't do that. Sometimes it works, but sometimes it blows up on you, and that's what you try to avoid.
Especially now we have an election coming up. A
lot of volatility.
Volatility, uncertainty, all the rest. We don't really know what's going to happen in the election. We don't know how it would affect markets because that's your short term versus long term versus 15 years out. Stock market's probably going to go up because it always goes up over the long term.
Good companies that sell a lot of good things to people. It's not going to matter who the president is. Apple's going to still sell a gazillion iPhones,
right?
And it doesn't matter. So when you're looking at good companies with good earnings, well run, good management, the person at the helm, they might impact some policy on certain sectors, but it's not going to affect good companies to any large degree.
I'm distracted over your right shoulder. Is that the Chrysler building?
That's my favorite building in Manhattan. Yes.
Right down the street from where I am here.
I like Art Deco, and I love that building. And it's getting overshadowed now with all the big buildings around it. But
it is a cool building.
It is.
But you don't like my? I have a bobblehead of Vin Scully and Daryl Strawberry over my. What is this? Left.
Oh yeah, there you go.
See that?
You see that?
So we have different backdrops. So I don't know. This is. I feel like the thing for me is like I covered this for years and years, and I just remember starting out, and even longer. It's like there's almost finance is weird. It's almost like this fake it till you make it type of thing. You kind of learn what you need to know, learn to answer the questions you need to ask, or whatever your job is. Even people work in finance, by the way, they learn what their particular corner of the job is. And I don't think people have enough basic discussions about these types of things, about what events like the Fed or whatever it may be kind of mean to them. And then they think they know, but they don't. They don't.
It's funny you say that. We have a number of people in finance as clients because, to your point, they're excellent at one particular thing. They might trade dollar yen better than anybody in the world, but what are they doing with their personal finances? And so, a lot of times when they check their ego and say, okay, I can use some help with someone who focuses on personal finance, and what happens is a lot of times we're listening to friends and family. And I always say, everybody is really well-intentioned. Everybody who cares about you has your best interest in heart, your friends, but they don't really know 100% your situation, what your goals are, where you're coming from. And out there, we see people, they dress nice, they drive nice cars, whatever. We don't know what's behind that. We don't know how much debt they have. Could have no
furniture in their house, for all you know.
Yeah, they might have a ton of debt. They might have gotten a big inheritance. You don't know what's backstopping them. Those kinds of things.
You have the positive outlook. I'm thinking they have no furniture in their house, but both could be true. Both could be true. So the idea. So we're starting this thing. We'll see how it goes. We're going to put a few of these episodes out. It's called No Dumb Questions, right? And you can hit us up on social media. My social media stuff is all the same because no one has my name except my dad. But it's at Connell McShane, so ConnellMcShane, and all the social media. Doug's at Flynn Zito, which is his firm, Flynn Zito, at Flynn Zito on X or Twitter,
Yes.
and at Doug CFP and Certified Financial Planner on the Instagram at Doug
Right.
CFP. So yeah, you get a question, or if you watch it on YouTube, wherever you're watching or listening, drop us a question, maybe an idea for an episode, and we'll try this out. I feel like there's a need for this, and we'll see. And if no one
Great.
wants it, then we won't do it anymore, right?
Well, hopefully we can bring some value and people can pick up a couple
Exactly.
things, doing a little deeper dive than you can do in a couple of minutes on TV or so. So this will be
Yeah,
great.
there are dumb questions, but not here. No dumb questions. He's Doug Flynn. I'm Connell McShane. Thanks so much for checking us out here, episode 1. We'll see you next time.